Welcome to our second segment, Emerging Markets and Lesson of the Week. This is for October 14th, 2023. So as we looked at in our market analysis, we noticed that, there was a big event happen over the weekend, but yet this is as a Wednesday. When we look at all the markets for the week, they're mostly in green. And a lot of markets are in green year to date. So again, they kind of focused at that time, they were focusing on more of general fundamentals of the economics. So they kind of, again, it was a reversal on Sunday night or Monday morning, Monday morning when the markets opened. But when you look at, this is something I want to take a look at. These are the international ETFs. And I want to pay attention to this, the moving averages. This is the 50-day moving average. This is for 2-month period because I want to see what has happened in past 2 months. And then we look at the 20-day moving averages. And every one of majority of them, you see these moving averages play a big role. This is the Australia. Some of them did not even reach to the 20-day moving average. The strong one has been India, for instance. We talked about that. But look at Hong Kong. We look at Germany, did not even get to close to 50. It got rejected at 20. The same thing in Europe, other countries like France. And then we look at China, got rejected at 50-day. Canada got rejected at 20-day. And then you see Japan, 20 crossing 50. And generally, a lot of markets, these technicals come into the picture. We see Taiwan is just sitting on its 50-day moving average. And so is Sweden. So anyway, these are from the technicals I want you to pay attention. Talking about the world economies, the IMF has updated its forecast with oil price up, but the China cut. As I mentioned, there's a lot of question marks around China. So, and then of course, what is happening from geopolitical side of things. But believe it or not, this is something that coincides, this is right before, the geopolitical things happening. So the growth projection is upgrades for the US, Brazil, and Russia, but downgrades for the EU and China. Now, when we look at as a positive in Latin America, it's neutral for the Gulf states and neutral to negative for East Europe and negative for Africa and Asia. Again, with the supply chain, the commodities, and we just looked at, for instance, copper. So this is their forecast. And again, I mentioned it's up for US and Brazil. So what you could see, again, the largest emerging markets, what is happening to China, negative 56, Taiwan and Thailand. And then we got positiveness in, for instance, Brazil, Mexico, and Russia. And then we see there's a commodities, like there's negativeness for Vietnam, for instance, the projections. And then we see Iraq, Iran is positive. But again, we've got to take the geopolitics into account. If there's going to be lasting effects. But at the end of the day, I have mentioned it in our class, it's all about the economy and the demand. So anyway, so that's one thing. Talking about Europe, going back to the emerging side of the Europe, Eastern Europe, you see that Poland offers pretty attractive valuation. But when we look at it from the currency side of the things, it's pretty richly priced. All of these you can see. Turkey is on a spot, looks attractive, but when you look at the real interest rates versus, it's pretty expensive. So anyway, so that's another thing about emerging markets. Now, of course, there's this question. It's not, when we talk about the politics, it's not about just Hezbollah and Hamas, which they've been funded by Iran. it is about, will they be dragged? Will Israel plan of going a pretty large scale, and will other countries be involved? So I thought, let's look at Iran and Israel's conventional military power. So the lower the numbers, the stronger they are. So we are looking at the Middle East, North Africa, for instance, region. You see Turkey has the most efficient, or has the strongest. Egypt and Iran and Israel, and they're pretty even. So this could be very dangerous, either one of them. So Israel might be thinking it's better, if they can leave Iran off from the conventional point of view. I don't know what Netanyahu will do, but I just want to share with you what's happening. You can see Lebanon is the weakest. When you look at the global 10, you see where US and Russia and China, how close they are, close they are. And then this India, UK, and South Korea, Pakistan, Japan, France, and Italy. All right. The next one is worrisome about, again, what is happening with the defaults around the globe. And these are the spreads over the treasuries in basis point. You see how much of a danger Ethiopia is. So that could be a big default, and we'll see what will happen. But they, and then Tunisia and Pakistan, they are in a big danger. And of course, we keep hearing about Argentina, the inflation on one hand, and of course there's election, and there's big trouble. But they've gone through this so many times. I remember many times. But anyway, so this is the ranking of the most countries with the high default risk. As far as the lessons, gonna look at, first of all, what happened on Friday, and then again, flight to safety. You have to remember, it's a weekend coming, right? The unknown. Just think of last weekend. So the markets are, not gonna sit and just wait for the weekend happen. They have to protect themselves. So I wanted to share this with you. You can see how the big mega cap stocks, they were down big time. On the other hand, we've had energy was the big savior on Friday. You can see it was up 2.2%. Financials, after the good earnings, they were up as well. But also the staples, defensive stocks were up nicely, as well as utilities and the healthcare. So again, risk on, risk off. So we can see that these were the places that the money went to. From where? From the discretionaries, like XLY was down. We look at the XLK, was down 1.4%. So generally, you can see how gold was up 62 points. I mean, 3.34%. So even Bitcoin was up. And then obviously the VIX, we talk about that. So that's important. And on the other hand, you see the Russell and NASDAQ were down big time. So on top of that, just looking at the 1 week performance, you see that the VIX was a big winner. Oil Brent. So you see Brent was higher than, had a more as far as gains than WTI. And it goes, again, the close proximity to the Middle East. And again, this is something that they get affected more. So, and of course, the transportation, the Gulf, Persian Gulf, the Strait of Hormuz, Mediterranean, and it's like, so basically they were the big winners, talking about heating oil, crude oil, VIX, and coffee, and then WTI, gold and silver, obviously. So, and then 30-year bonds. So keep these in mind, because we're going to discuss this. And the other thing I want to share with you, JP Morgan, Wells Fargo, Citibank, they had their earnings. They were up really nicely as soon as the earnings came. So these two finished positive, and they were, you can see some of these financials were positive. So they carried, again, they also helped the market. So this is, I've discussed this before. We discussed it in our geopolitics, but have a copy of this. I think it's helpful. Every morning when I look at FinViz, for instance, these are the things that I want the story to match. I want to see the players are doing their own roles. They're not, there's no contradiction. So, when we see Dow Jones and Australian dollar and Russell and NASDAQ, financials could be either way, but generally the financials are from the good economy. If they're all down and crude oil is more of a nice to put it in the blue, that could be both ways. Crude oil could be a sign of a healthy economy. So if the risk is on, they usually go up. But when there's a geopolitical risk, especially where the producers are, obviously that becomes a hedge. Risk off, like Friday, you can see VIX, Japanese gold, and dollar, for instance, treasuries and gold. So these three, VIX, gold, and treasuries, are the first reactions when there is. So it was interesting that dollar was up and gold was up again because of the risk. So changing the subject, last year, if you recall, we were looking at 2023, and we also looked at the sentiments and other things, and we thought October, it was beginning of something, and there was obviously the elections were coming, but this was a study done in 2012. So I thought, let's go back and review that. What is the patterns with the year of 1, 2, and 3? And you can see generally every single bottom that we've had, it has ended in year 2. So 1932, we bottomed, and then 2013, we went up. So this is the following year. It is this case also was for us right now, we are looking at the third year of presidential, but this is 1932, 2002, the bottom happened. 1942, the bottom happened. 1962, and so this was done in 2012, and the question was, is this going to be a bottom? And actually, the question was yes, it did become a bottom. So these are the things, they are in the year 2, the bottoms actually happen. So again, we looked at the cycles and other things. So I thought this study was done, and I just want to share that with you. The other things I was looking at is that we just had the consumer sentiment came on Friday. And, once it came out, we could see there was a little negativity, less than expected. I want to take a look at what happened in 2022. And that was the lowest since we've had since 1979, 1980. And that coincided, the most negativity coincided with what? With the market bottom in October. So let's take a look at, I have these every year since 1961. So all the consumer sentiments. And once you, again, 2001 to 2023, you see the 2022, 59 was the lowest that we've had. So that gave us a little heads up again, sentiment, right? So tells us when everything is, there was so much worry about inflation, there was with recession, there was a lot of thoughts in October. So that's again, contrarian point of view. All right, I hope that was helpful. This is our second segment, and we will go to our trade of the week next. Thank you so much.